Hello, everyone, and thank you for attending this webinar on internal transfers. My name is Michael Desiato, and I'm a tax partner here with Cherry Beckert. As a certified exit planner and as a certified growth advisor, I help mid-sized business owners tackle one of the most significant financial events in their lives, that being the successful exit from their companies, in a manner that is both consistent with their overall personal and financial goals, all the while keeping them in control of the process. I do this by working with them and their internal and external teams to build transferable value in their companies so that they can stage a successful internal transfer. So let's go over what we're going to talk about today. The agenda for this webinar is, as you see on the screen, is I'm going to talk about the internal transfer as your exit path, and then I'll talk about the 2 steps that you must take before you start on this internal transfer process. Then I'll cover 3 guiding principles that need to be in all successful insider transfer plans. Then I'll cover 9 elements that has to be present in these plans. And then I'll get into a detailed discussion of the 2-step insider plan that I use, along with the tax consequences surrounding it. And finally, I'll wrap up with some key plan design considerations that you should be aware of. Okay, let's talk about internal transfers. So as I said, today I'm going to talk about internal transfers. Now, an internal transfer is one where the business is transitioned to either the next generation or your key employee group. And one of the biggest myths and misconceptions that I have noticed when talking to business owners over the years is the notion that when it comes time to exit, they will just, they'll just sell their business and retire. Well, the reality is that fewer than 20% of all businesses taken to market for sale close. In fact, close to 70% of exit transactions are internal transfers and not sales to outside third-party buyers. Now, the reason for this are many, and let's just discuss a few of them. Many owners just, want to preserve the legacy of their company and their culture, and therefore they want to do an internal transfer, or they feel a sense of loyalty or obligation to either their children who have worked with them in the business or their key employees who have helped them build the business, and they would like to then transfer the business to them. The other thing that drives internal transfers is that not all businesses will qualify for a sale to an outside third-party buyer because these buyers have minimum size requirements. For example, in an S corporation setting that wants to perhaps install an ESOP plan or employee stock option plan, you cannot do so with only a few employees working in the business. You generally need about 10 unrelated employees for the economics and requirements of an ESOP to work. Another example of a size requirement comes with the world of private equity or a strategic buyer. Companies with earnings of less than $1 million generally will not qualify for consideration by these buyers. And additionally, in order to be a good candidate for a sale to an outside third party, your business must have a strong and deep management team that can run the company without you. It has to have steady and defensible profits and predictable cash flow, and also customer and vendor diversification. And many of the business owners, mid-sized businesses that I see, do not have all of these items. So as a consequence, if you're like these the 70% that must look to an insider transfer as your exit option, I'm here to tell you that a properly structured, planned internal transfer can provide you with financial security while minimizing your risk, maximizing your after-tax proceeds, and keeping you in control of the process. So my goal today is to discuss the necessary steps and considerations for you as a business owner to take in order to stage a successful internal transfer. So as my title slide says, are you up for the task? Okay, now before we get into the details, let me cover a couple of critical steps that must be taken before you start planning your exit. The first thing you really truly need to do is you must have a plan for your life after you exit. You cannot commit to an exit plan until you can clearly see and accept that the business is no longer your life. And that's pretty difficult for a lot of entrepreneurs, but you have to be able to accept that and see that. And on the financial side, you also need to quantify your financial goals. So this first step essentially is broken down, it can be broken down into 4 essential questions. First question is, when do you want to leave your company and what does your life look like after you leave? Then the next one is, well, who's going to be your successor? Thirdly, how much after-tax dollars do you and your spouse need to each year for the rest of your lives to live out your retirement years in the fashion you desire? And finally, how much do you wish to pass on to your beneficiaries when you die? So those are very critical. Those need to be addressed before you start this any exit planning process. And I would say also that as far as the last two questions are concerned, I recommend that owners do a full financial plan with an experienced financial planner and resist the back of the napkin approach. You're going to really need to get a very solid read on the amount of investable assets that you're going to need to fund your annual consumption needs and legacy gifts, taking into account inflation, taxes, and other post-retirement needs as well. Secondly, the second key thing you need to do is, once you determine what your financial goals are, you need to take your present temperature, if you will. You need to understand what the value is of your present day assets, including the value of your company. And when it comes to valuing your company, again, resist using rules of thumbs or guesses. Every company is unique. You need to have someone who values companies for a living do a valuation for you that combines it with an assessment of your company and then ties that assessment back to a business value. That process, you're doing the assessment and tying it back to a business value will help you understand what the drivers are to the value of your company. And that's very, very important. So after you've done these two steps, you know what you need, you know what you have. You have to determine if you have what we call an asset gap or a wealth gap. And that gap simply is the numerical difference, if you will, between what you will need to have when you retire versus what you have today. And in most cases, you will have a gap. And in most cases, most of that gap will be attributable to the value of your company. And the gap can be enclosed by increasing the value of your business and its cash flow over the time frame you have until retirement. Well, question comes up, well, how can I close this gap? What can I do? Well, if you do the valuation and you have it done properly, you'll understand the value drivers of your business. And if you then develop a disciplined plan and approach to close that gap, you can do so by improving your business profitability and cash flow, and hence its ability to provide you what you will need when you retire and later. Also, it's very important in this step to work with experienced advisors. Calculating what you have and what you need is straightforward and accurate when you use the right advisors. Doing these calculations yourself is very simple because facts don't get in the way. Likewise, you're going to need to work with experienced exit planning and growth advisors to help your team assess your company value drivers and help you chart a path and guide you to improve the value of your company, which will result in needed cash flow. Okay, so now that you know what you need when you retire and what your financial legacy will be, you know what the value of your assets are today and what the size of your asset gap is. We can now turn our attention to what is needed to successfully stage an internal transfer that will help you close that asset gap and achieve financial security. But before we get into the details, we need to review some guiding principles and some necessary elements of a successful internal transfer. There are three guiding principles that I follow in all insider transfer planning. These three guiding principles are, number one, I keep you, the business owner, in control of the process. Very important. Number two, I minimize your risk. And thirdly, I maximize the receipt of value over time. So with these three principles as a foundation, now let's turn and look at the 9 elements that must be present if an insider exit plan is to succeed. The first element is probably, and one of the most important ones, is time. In order to an insider transfer to be effective, unless the buyers have their own source of cash, you're going to need to be willing to take time, typically somewhere between 5 and 10 years, to execute and complete the transfer along with your insider buyers. And typically, the more time the owners take to transfer the company, the less the transaction risk they incur and the more money they receive. And I'll show you that shortly. So the takeaway here is it's a long process. Secondly, you're going to need sufficient cash flow. You know, while healthy cash flow is critical to the success of any type of exit, no insider buyer wants to buy a company with anemic cash flow. In a transfer to insiders, however, cash flow assumes critical importance because initially, but only temporarily and if designed correctly, it is a major source of funding for the owner's exit. Your key employees most likely will need their share of company cash flow to execute the insider transfer plan. Now, like most business owners who have an asset gap, a growth in company cash flow will be necessary to help you achieve financial independence. Your plan design must create a powerful incentive for management teams or your successor teams to generate and grow cash flow to reach your number. If the successor group is motivated by ownership potential and by you igniting that self-interest of the group by designing the plan properly, that's an ideal way for you to significantly grow cash flow. So the takeaway here is that the plan needs to be designed to provide incentives for the key employees, for the key employee group to grow company cash flow. The third element is capable management, desiring ownership. You know, you need to have a motivated management team in place and capable of replacing you. This is very, very important. In a transfer to insiders, capable management must also desire ownership and be willing to sign personally for any acquisition financing or ongoing company debt. You know, owners, in my opinion, often assume that their management teams or children want to own their companies, but only until they realize that they have to potentially personally guarantee a loan to purchase their interest as that interest fall apart. So takeaway here is you have to have capable management that desires ownership. And we're going to revisit that topic very shortly because that's an important one. Fourth principal element is you need to focus on taxes, okay? In an insider transfer, it is imperative that you structure the sale to minimize taxes on the company's pre-tax cash flow, because without planning that cash flow, if you don't plan properly, that cash flow can be taxed twice. Now you may say, how does that work? Well, think about it. Once when the insiders receive the cash flow or receive profits or they're taxed on their profits as new owners and they pay taxes, they're going to turn around and take that after-tax money and they're going to give it to you, who are then going to pay taxes on it when you surrender your shares for those proceeds. So let me take a quick moment to kind of review this double tax issue in a very simplistic format. I went too fast there, but let's look at this situation here. Let's take a look at this. So if your company will have $10 million of cash flow over a number of years to support your exit, and the insiders will use that cash flow to pay for your shares, then assuming that they are in a 30% tax bracket, on that $10 million after 30% taxes, they'll have $7 million left, and you can see that on the left-hand side. If you follow the arrows, you go from 10 million, here's their tax liability of 3, they have 7 left. Then they're going to give you that $7 million to buy your shares. You being in the 20% tax bracket will pay $1.4 million on that $7 million, netting you $5.6 million. If you do the math here, that's an effective overall rate of 44%. And this is double taxation, I can tell you. This is something you need to avoid. So our goal in planning in these insider transfers is to avoid having the company cash flow taxed twice. We'd like to have it taxed only once. And if you can do this, you could shield up to 20% or more of your company cash flow from double taxation. One-time taxation means you receive more money more quickly, thereby reducing your risk of payment. Now, non-payment debt. So if you go to the next example, just to contrast this to the previous one, if instead of using all the $10 million to purchase your shares, the new owners use 50% of it, or $5 million, to acquire your shares, and use the other $5 million to pay you deductible, current, or deferred compensation, or just distribute out to you your share of income from the entity until you are completely bought out. So if you do the math here, if you take the $5 million that would be paid to you for your shares, that would be first taxed to the new owners at 30%, reducing it by $1.5 million. So they would have $3.5 million left to give to you, and you would have to pay 20% of that, or 700,000 on that piece of the buyout, which is for your shares. And then the other 50% is paid to you as deductible compensation, which you will pay 30% on, which is $1.5 million. And when you do the math there, you'll wind up with $6.3 million of money in your pocket. And if you compare that to the previous example, that's $700,000 more than what would have happened if 100% of the money was used to buy your shares. And the reason for that is because I've had half of the cash flow only subject to one level of tax. And by doing that, I got more money to you, and I got it to you, and you'll see in a minute, I'll get it to you even faster. So the takeaway here is, in designing these plans, you should avoid double taxation on company cash flow. The fifth essential element here is that one of the most important advantages of a well-designed insider transfer plan is that you should have incremental transfer of ownership. The owner should be able to, should have the ability to regulate how ownership is transferred, the timing of the transfer, and how much ownership is transferred. So if the company performance falters, if employees stumble, if you decide to sell to an outside third party, a well-designed internal plan keeps you, the owner, in control. So the takeaway here is the owner should stay in control of the process. Sixth critical element is minimal owner risk. So while you take risks every day, I am sure that you don't relish taking yours and your family's financial future security at risk. Therefore, I use strategies to hold voting and operating control in your hands and shift operational business risk from your shoulders to that of the incoming owners, so that you stay in control of your company until you receive the entire amount you need to secure your financial security, and not a moment sooner. So the takeaway here is minimize owner risk. Seventh element is the plan needs to be written. Okay, the transfer plan should be contained in a written document and be communicated clearly to the eventual owners. If the plan is not in writing, it simply is not credible, and neither you or your successors will take it seriously. More importantly, the written plan is the playbook that you'll use to coordinate your actions, those of the new owners, and those of all your advisors. All plans should also include a timeline and provide for accountability. Who will do what, when, for all the participants. So the takeaway here is that there really isn't a plan unless it's written, communicated, and it has timelines and accountability. The eighth principal element is owner education. You as the owner need to understand the ins and outs of the insider transfer, because unlike a sale to third party, you control the business and the exit process until you receive all your money. So your exit planner needs to be providing you with this education. So takeaway here, your advisor needs to be educating you along the way. Finally, last principal element here is that you need to have experienced advisors. Your exit planner is the quarterback of a team of advisors who have experience in this area. The more varied the experience, the better able they are to foresee and meet contingencies and unexpected events. Takeaway here is that exit planning is a team sport. No one advisor has all the answers and the skills to make it all happen. You need an exit planner, all right, someone who's experienced in this area, to act as the quarterback of that team to make sure everyone is working together and with your goals in mind. Okay, now that we've gone through these goals and elements, let's get into the two-step insider plan and some plan design considerations. But before we do that, I want to stop and take a moment here to talk about this. And that is, you need to test your assumptions about your successor group, either your children or your key employees. All right, so the questions you need to ask yourself here are, do you have one or more key employees who wish to purchase part of the company and take on the risks of ownership? If not, then you may need to explore other exit alternatives, such as a sale to a third party, or keeping the business and building wealth outside of it to retire comfortably. You also need to consider the age of the successor group. If a member is older than 50 years old, he or she may not be willing to acquire shares over the next 5 to 10 years, and then have to resell them back at retirement at a low value. Those type of employees would be probably more likely to be more open to receiving some type of synthetic ownership, such as a phantom stock plan or stock appreciation plan rights. And finally, you also need to know when your key employees retire. Okay, so you have to do a pretty solid assessment of your successor group and make sure that your assumptions here are correct. Because if they're not, if you don't have people who are willing to take on the responsibilities of ownership, have no desire to be there, then you have to reassess whether or not an insider plan is appropriate for you. Okay, so let's assume that you have a committed successor group and to transfer your business to. So let's talk about how this two-step plan works. Okay, so in step one of the plan, you're going to sell a significant portion. By that I mean 30 to 40% of non-voting shares to your successor group over a long time frame, typically 5 to 10 years. Meanwhile, you're backing away from the business and you're starting to turn over operational control to those key employees. So, and the other issue that comes up here is, well, Mike, I don't have voting shares. I don't have non-voting shares. Well, that's not hard to rectify. If you don't have voting shares, you can simply do a tax-free reorganization to get you there. And if you're an S corporation, you are permitted to have voting and non-voting shares, so it's not a problem. And what happens here too in this first step is that the key employee groups, having no money typically, will give you their promissory notes for those 30 to 40% of the shares, and they're going to use their share now of company cash flow to make payments to you on those notes. And sometimes I get the question about why is it 30 to 40%? Can't we accelerate that? Can't we do it faster? Can't the key employee group go out and borrow money, get SBA financing to buy out the owner immediately? Well, the SBA lenders that I know tell me that before they'll provide financing on an internal buyout, the key employee groups must come up with at least 10% of the purchase price with their own money, And also the owner must take back at least 10% of the price with seller financing, and then they'll finance the remaining 80% up to $5 million. So given these restrictions on financing when the keys don't have much of an ownership stake, particularly the loan size, my insider plan design of having the key employee group acquire 30 to 40% first will help them get the necessary bank financing needed to buy you out. Yeah. The other point here too on these stock share sales is that these sales are done at something called lowest defensible value. Lowest defensible value is the minimum amount that can be, or the minimum value that can be placed on your company as determined by a valuation professional that will hold up under IRS scrutiny. And the use of this lowest defensible value avoids subjecting the business cash flow to double taxation, which means you're going to have more cash flow to pay you, the owner, faster. And most often these transfers of non-voting shares are not immediately vested, but are vested over a set time frame to motivate the key employee group to stay and to penalize them if they leave before the plan is completed. Continuing on here, typically in these plans too, each key employee who purchases non-voting shares must also enter into a stock buyback agreement with the company that provides for the repurchase of the stock in the event of their death, disability, or termination, often at the same price that they paid for the shares. And the agreement would also contain non-compete, non-interference, and confidentiality provisions, all of which are to protect the owner and you, the owner, in the business. And also, this is very critical as well. Non-voting shares are only done, you only make these transfers if the successor group or the key group has proved their ability to produce the projected increased cash flow to fund the plan. Otherwise, the owner is using your own money to basically buy yourself out. So we designed this so that, and we incent the key group to increase cash flow and use that increased cash flow to fund this first step, the purchase of the non-voting shares. Okay, once that is accomplished, then we get to step 2 in this process. In step 2, we use direct payments to the owner during this buyout period, and followed by an ultimate sale of the owner's voting stock. And as I previously mentioned when I spoke about taxes, I combine the sale of shares at lowest defensible value with tax-deductible payments to you to help you achieve your financial goals, so that I lower your risk of getting you your desired amount, and I get it to you much faster. What you'll see in a minute is I'm using money that would have gone to Uncle Sam to fund the program. These tax-deductible payments can take on many forms. They could be either distributions to you of your share of current or retained profits. They could be additional current or even deferred compensation, or they could be additional contributions to a retirement plan for you. And then the final step in this two-part plan is for them to purchase your voting shares with the proceeds from outside financing. Once they own 30 to 40% of a successful and growing company with strong cash flow, banks will be willing to lend them the buyout money. Only when you receive this final payment, though, do you finally give up control, not a moment sooner. Okay, again, one of the guiding principles here was to keep the owner in control of the process. So let me go through an example. I kind of give you some summary numbers here. I have the detailed calculation. Let me show you how powerful this two-step plan is, and how it is very tax efficient. So let's say we have a company that's worth $10 million, and the amount of annual cash flow available for planning purposes is $2.5 million. Now, if the owner were able to sell the company for $10 million to an outside third party, after taxes at 20%, he would net $8 million, right? He pay 20%, he or she would pay 20% on the $10 million purchase price, and he'd have $8 million after tax. Okay, well, we're not talking here about a sale to an outside third party. That's not in the plan here. We're gonna do an insider transfer. So the question is, how can I get that same $8 million to that owner to add to his or her retirement nest egg? Well, I essentially have two options. One is this two-step plan that I just outlined for you. So this plan first will start with the sale of about 40% of the non-voting shares of stock over 4 years, 10% a year, let's say, assuming that, again, financial targets are being met by the key employee group. And then I'm selling that at 40% at a 40% discount from the fair market value. That's the lowest defensible value notion. I'm not selling it at full fair value. I'm selling it at a value that I could justify, but it's much less than full fair value. The key employee group will give you notes back bearing interest at 4%, and then you would get a payout of your owner's share of income, assuming it's an LLC or S corporation, over that 4-year period. And then at the end of the 4-year period, they would come back in, the key group, they get outside financing, they buy your 60% voting shares, again at a discount. I'm using 30% here, not 40, because now they're getting control, so the discount would be less. And then if you do, as I did here, if you do the math, your after-tax proceeds at the end of year 4 is approximately $8 million. Okay, so there's where I got you the $8 million. It took 4 years, but it can be done. Now, the other option, and the one I try to avoid, and I tell people, please don't do this, is from the outset, do an outright sale of the entire amount of the company to your insiders for pretty much the full purchase price of the company, the full value of the company, taking the 10% discount because it's not marketable. If that is the case, if that is the plan, then with the annual after-tax cash flow available to the new owners, which is about $1,750,000, it'll take them 6 years for them to pay you on your note. When they give you that $9 million note, it'll take them 6 years to pay you off. So as you can see here with the two-step process, the time frame to get you the same amount of money, which is $8 million, all right? The same amount of money after taxes, $8 million, I can do it in 1/3 of the time. I can do it in 4 years versus the 6 years if the transaction is cast as a full outright sale of your shares. And the reason for this, again, is I'm avoiding double taxation by making direct payments to the owner, to you, the owner. And that's why I can get you the $8 million faster than if you embark on a transaction where you sell your entire shares and that's it. And also, it's less risky for you in this two-step process because you don't give up control. and you are in control until you get your final payment. All right, a few more considerations in this planning to discuss. Let's go through them real quickly. One of the things that comes up is, well, what happens at the end of phase 2 of the plan? Do you want to commit or contractually commit to selling all of your shares at the end of phase 2? And if so, what price? That's an open issue. You could do something different there. Or do you want to give the key employee group the option to buy you at the end of phase 2? Or you and the key employees can agree to allow you to continue to own some of the stock at the end of phase 2 before they buy you out. And finally, you and the key employee group can agree to leave your options open at the end of phase 2. You may be able at that point in time to sell to an outside third party, and everyone can benefit at that point. So these are some of the things you may want to consider when you talk about the buyout at the end of phase 2. There are some options there. The other issue that comes up is how much risk should be shifted to the key employee group. The two-step process allows you to stay in control and sell your remaining voting shares only after the key group has shown that they can manage and run the business. But how much risk should be shifted to the key employee group if there is a downturn in cash flow during phase 1 of the step 2 process? So here are some of the things that you could consider if that could happen. You could delay the principal and interest payments on the promissory notes you get back, and then you have to determine how long can you delay that. You may want the key employee groups to use some of their money for a down payment for the initial stock purchase, so that you could guard against a downturn in cash flow. Or there are certain circumstances where the key employee groups are required to post personal collateral, such as their personal residences, as security for the notes they give you for the sale of your non-voting shares. So these are some of the things you may want to also think about to try to manage the downside if cash flow and things don't work out as you would like them to. And finally, and lastly, as you can see, and as we discussed, you really need to have consistent free cash flow. And free cash flow is really cash flow that's available to the owner, to the ownership group, that's not needed for operations, taxes, or capital expenditures. It's also, as we saw, it's also going to be the source of cash that the key employee group is going to need to help pay you for your non-voting stock, and as well as all those direct payments to you in step 2. So they're going to rely on this company free cash flow in order to buy you out. So, in this whole process, you need to project it. You need to project free cash flow. You need to show how distributions in that cash flow will help implement step 1 and step 2 of the plan. You have to share that with the key employee group or the buyout group to demonstrate how they can fund the plan. And in fact, as previously stated, most plans require that the key employee group grow cash flow, all right, in order for more non-voting shares to be offered to them. And as part of this planning too, at the same time as you're doing this, you start backing away from the business. You need to, as you start backing away from the business and you start turning over control to the key group, you need to protect yourself and the remaining key employee groups by having them sign covenants not to compete, as well as buyback agreements should they leave the company. And finally, too, the last point I want to make here is that if you can't project, or if you think cash flow is insufficient or is historically sporadic or cyclical, you must stop and reevaluate the internal transfer. This process may not work for you. You may need to have the key employee group use more of their money to buy in, because there's not enough cash flow that the business will generate to help them get you what you need. Or if you may want to design the plan to focus more on business value creation to generate the amount of free cash flow necessary, and then only sell shares to the key group if the growth goals, if they help you meet those growth goals. So my closing thoughts here, and I'll wrap it up, is that a well-designed and properly planned internal transfer can provide you with the same after-tax proceeds, and possibly more, than a sale to an outside third party. It also helps keep you in control of the process throughout. And since most of these transfers take a number of years, all right, you need to start the process now. Don't wait until it's too late. Time here is your friend. So I would end this by saying that don't put this off. If you want to proceed on this basis, or we want to proceed with a plan like this, you got to start early and you got to start soon. So are you up to the task?